Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. In a key moment for the U.S. economy, the Senate does pass one of the most ambitious and divisive budget bills in recent history, Trump's $3.3 trillion legislation. Right now, the market reaction appears mixed on the Senate passing of the big, beautiful bill. Up next, it awaits House approval, of course, and we're discussing what this all means from Washington to Wall Street. Let's welcome in now Lou Bassanis, Executive Vice President of Market Strategy at Prairie Operating Company. He's also founder of thebigskinny.com. Our Washington correspondent, Ben Werschkul, and senior reporter, Alec Now, all here. Ben, start with you. The deal is done, my friend. So what do investors need to know, Ben? Walk us through it. How will this impact our economy?
For sure, yeah. So this is a 900-page package, so I won't go through everything. We learned this weekend that it takes 16 hours to read this whole thing from start to finish. But three areas to zoom in on in terms of the economic effects. The first and foremost is that this is a tax bill, and taxes are the reason this bill is going forward and what Republicans are doing it. This will keep individual rates at current levels. They're set to expire at the end of this year based on the 2017 Tax Cuts and Jobs Act, so those will be extended permanently. There's a bunch of Trump campaign promises in there, no taxes on tips. Where economists are going to be looking most closely for economic growth and economic change in the years ahead are a bunch of business world provisions in here. These are tax credits for things like R&D. That is where sort of the White House case is as to sort of why we're going to see a lot of economic growth. So that's the tax piece. Quickly on a couple others, energy is another huge one. This has been a huge focus in the last couple of days. This bill at the last minute really shifted towards fossil fuels and away from green energy. There was one kind of step back at the last minute, but this is what Elon Musk is objecting to. This is what clean energy advocates are really up in arms about, which is that this bill phases out Biden-era green energy credits faster than had been expected and has new inducements for fossil fuels on there. And then the third is healthcare. This is what we've heard about most of the final debate on this bill. Most of the focus rightly is on the fact that projections are here that 11 million Americans could lose their health insurance as a result of this, but just purely on the economics, this is a bill that takes about $900 billion out of the healthcare sector over the coming 10 years. So that's going to have a lot of economic ripples that we're going to be talking about. So those are the big three. There's a lot more for certain.
So Ben, handicap this for me then, my friend. Does this get through the House, even with those fiscal hawks? I'm thinking about guys like, Congressman Chip Roy out of Texas. I saw a congressman on X. He does not appear thrilled here, Ben.
For sure, yeah. There's a lot of noise from the House Republicans. The House is already considering this. I should mention that we're about an hour and a half into a House Rules Committee hearing, which is setting up the stage for votes as early as tomorrow. But as you mentioned, there is a number of fiscal conservatives who are saying they're not going to vote for this bill as is. The bottom line is the only way this bill gets to Trump's desk by the July 4th deadline he set is if the House just accepts this exactly as it is, doesn't even change a single sentence in there. A lot of Republicans in the House are not eager to do that. They're saying they're not going to do that. What I would note is these are the Trumpiest Republicans in the House, and we're going to see a lot of arm twisting from President Trump over the next few days, who both wants to get this done so that it doesn't change. The longer you keep a bill out there, the more it changes, and also because he wants to keep this July 4th deadline. So we're going to see a lot of political pressure in the next couple of days. Whether the Chip Roys of the world, as you mentioned, fold and just go ahead with this is what we'll learn in the next 24 hours or so.
All right, the drama continues. Allie, how have investors reacted to the news? Walk us through it.
Well, we're seeing a little bit of pullback from the record highs that we saw over the past few days. The Nasdaq Composite is down about 0.8%. The S&P 500 was trading near the flat line, took a bit more of a leg lower, down about 0.1%. And the Dow, the only index to be trading firmly in the green here, up about 450 points. But we were just talking about some of the provisions to this bill. And to that point, there are certain sectors of the market that are going to benefit and conversely not benefit from this bill. Nasdaq Composite, we were just talking about how that's been pressured here. So I want to flip over to the NAS 100 because you're going to see some of those bigger stocks under pressure here. We have Alphabet down about 0.7%, Meta, which has been a standout of the year, that is down over 2.5%, Nvidia down almost 3%. And one reason why is that there's a provision of this bill that passed with strong bipartisan support, almost an anonymous approval here. And and that was a strike down of the ban on state-level AI regulation. So this provision would have discouraged states from regulating AI for 10 years. So obviously that is something that big tech wanted. A lot of these companies, their executives, have supported President Trump in the lead up to the election and heading into inauguration. So that's a disappointment there. But while big tech suffering on that front, we are seeing that solar stocks are catching a little bit of a bid here. And you're seeing Enphase Energy. This was one of the worst performing stocks in the first 6 months of the year. That is now up 4%. Sunrun up double digits, 11%. And Solar Edge is up around 8%. And this also has to do with the bill here because the Senate voted to remove an excise tax on wind and solar projects. So here's why this matters, because the bill originally included this tax on clean energy companies that use a certain amount of parts from China. So there were some manufacturers that supported this. It would basically lessen the dependence on China. But then other manufacturers that said that this would actually raise the cost of their projects due to the fact that we still have a lot of parts that come from China here. So the fact that we were able to remove this tax is a bid for some of these stocks here. But it just shows how susceptible a lot of elements of the market are to these various policy changes that we'll be seeing here, Josh.
All right, and Lou, finally, your thoughts on the big, beautiful bill, Lou. What you think it means for investors moving forward?
So a lot to unpack here. I'll start at the top a little bit here. I think this was pass or plummet for the markets, right? If we had a deadline, a strict one from the president, and it didn't get done, the markets are going to really tank on that news. Earnings is key. We have a back half of the year, we have expectations for earnings growth to accelerate. We need to see that now. The economic benefits that Ben was talking about need to come to pass. If we look kind of sector by sector, look, solar and wind have to stand on their own right now. I work with an energy company, so admittedly I'm biased, but if you just look at the data, go to Alex Epstein's Energy Talking Points and look at the data for these subsidies. It was a slight phrase that changed from put in service to under construction. It went back to put in service. That eliminates about $1 trillion worth of subsidies. You've got we need so much energy. It's got to come from all sources. So solar, wind, hydro, fossil fuels, if we're going to be a player in the AI race. I mean, China is off to the races with 10,000 terawatt hours worth of electricity. U.S. hasn't budged in years. So I think all in all, it's good for the markets. We needed this to happen. If we didn't, we'd be staring down another endless kind of unknown, like the tariff trade war, which hopefully is coming to resolution soon too.
All right, well, here's who's not happy about the big, beautiful bill. We know that Elon Musk, not a fan, and President Trump taking to social media to respond to Musk's ongoing critiques of the bill, focusing on the government grants that Musk companies receive. Without subsidies, Elon would probably have to close up shop and head back home to South Africa, wrote the president. Yahoo Finance's head of news, Miles Udland, joins our team coverage for his take on the second round of Musk versus Trump. It is a second. 2 men enter, 1 man leaves Musk, 2 800-pound gorillas. So Musk says, this bill is insane. I think utterly insane was the exact words. The debts, the deficits. Trump fires back, which I think we all saw coming. Says you're just upset about the EV tax credit. What do you make of it?
Well, I think it's kind of exactly what you could have seen coming from many months ago, even before the election, which is that these are two of, let's say, the most self-assured folks that we have in American public life. Confident, yeah, at the very least, and I think with good reason. But typically, those are not going to be longtime allies, especially in the trenches of things like trying to get a large piece of legislation through. Now, as we know, Elon Musk was interested in joining the government to make it more efficient, and obviously a bill that adds $3 trillion plus to the deficit is not something that's going to interest him. But I think bringing it back to the stock market, Tesla stock down 5% today. The stock's down 25% this year. And investors continue to say they don't like the fact that Elon Musk and Donald Trump are going at one another, and that Elon continues to be, I don't want to say distracted, but at the very least, preoccupied, occupied, interested. Like, he's spending a lot of time on these issues. And we're going to get sales numbers from Tesla tomorrow that the street doesn't think, or delivery number, excuse me, the street doesn't think are going to be very good. There are a lot of problems with Elon's core business, Tesla right now, that he said a couple months ago he was going to be fully committed to. I'm sure he's spending more time with those businesses, but the market's judgment in the time since he has, quote unquote, returned to Tesla has not really, full-throatedly gone back and said, you know what, we believe it. He's spending all his time there. And I think this latest spat is a reminder that Elon is not done picking this bone of kind of Trump's approach to government spending and how it doesn't align with his own, and the stock's performance reflects that.
Why do you think Musk, though, is engaging in this approach, Miles? He's making it so public. He's going on X. He knows he is, I'm going to put it nicely, upsetting, frustrating the president of the United States.
Yeah.
I would think he thinks, well, I can have a vote, I can have an impact on the votes. I'm worth $400 billion, and people are going to listen to me.
Well, he owns X, so he's got to go on. It's good for business, for him to go on that. But, there was something that he retweeted today, re-X, whatever we're going to call it. Reposted, I think is the formal term. There's a market on Kalshi, about 40% odds say that Elon will start his own political party.
Yep.
I think that's kind of what it's trending towards. Now, there's an argument, and we don't need to go into the full political strategy of this. A lot of people have come along with a lot of money and said, we need a third way in American politics.
Sure.
There's many of them out there still. Mm-hmm. It's not exactly an original idea that you get involved in the trenches of American politics and you say, you know what, guys on the left, I don't like them. Guys on the right, too extreme. I need to find the middle ground where everyone sits. Maybe he'll land there and that's fine. And I'm sure he's not going to stop spending money on U.S. political elections. And I think he probably enjoyed and can see the impact of his involvement in the process. But it's very clear that, and some of Elon's colleagues have talked about this, going back decades, he's always been obsessed with how the US government spends its money and trying to figure out, could it be spent better? DOGE is certainly an outgrowth of that. He's still a young man. He's not done with this project. So this is one bill, this is one moment in time, but I don't think Elon's kind of interest in figuring out, are there ways for the US government to act more fiscally responsibly, and how can he influence those? He's not done with that experiment, but the concern today is Tesla's down 5%. And investors don't love that he's not done with that experiment in this iteration.
Lou, your thoughts on this? I'm also curious, Lou, how this sort of plays out as kind of branding. And what I mean by that is how much time we spoke on this show with analysts who, when Musk was tight with Trump, they were saying, oh man, that's a bad move. Yeah. You're alienating so many Americans. There's Sheryl Crow. She's selling the Tesla. She's so upset, donating the proceeds to NPR. She's not going to have it. But now you upset Trump.
Yeah.
So how do you think through the branding, the marketing, the implications
Listen,
here?
Even the best soap opera writers couldn't write one with more drama than this.
True.
I think you guys are being a little bit more diplomatic. I mean, these are two megalomaniacs with a lot of money that can't keep
They're
their
just confident. I thought we agreed it was confident.
Okay, well, I'll go with that. Merriam-Webster had a different synonym for me, but they can't keep their fingers off the keyboard, really, right? I mean, Musk, to your point earlier, everyone wanted him out of politics, out of the government. You're interfering, focus on the business. He gets out, extracts himself. Tesla goes on a great rally. The fundamentals start kicking in, and now he re-engages. So I think, look, he's operating under all press is good press right now. He's a solution. I don't think he can help himself, but I do think, as a shareholder, I would stand back. I'm not a shareholder. I don't bet against Musk, but I don't love Tesla. As a shareholder, I'd want him to be 100% focused on what's going to drive the business, and that's not EVs. I mean, you talked about the delivery report tomorrow. Not good expectations. It's humanoid robots and self-driving cars. That's the future of Tesla, for it to live up to the valuation that it's got, roughly $1 trillion market cap, right? So I don't know. I know both of them have advisors that give them good advice in both ears. I don't think they ever listen. So I don't know that us opining here will get them.
I wouldn't call those two of the more advisor-heavy folks that we've got out there in the world.
Right. Yeah. All right, Miles, thank you very much. So the drama continues. We'll have you back for more on it. For more on what this all means, the latest market moves, geopolitical headlines for investors, let's welcome in here Jason Barcima, Halo Investing President and co-founder. Jason, it's great to see you. Let's start with the big news of the day, Jason. Senate does pass the big, beautiful bill. Now, of course, goes to the House. I'm just curious, Jason, how are you thinking through that, market implications? Was this all priced into the market, Jason?
Yeah, I think a lot of it is ultimately priced in. I think that a lot of people thought that Trump was going to be able to get this bill passed, but it's really about setting up for the second half, right? And as your previous guest just talked about, what are the earnings that we're going to see in the second half? What are really the tailwinds that we're going to see? And most importantly, what's the central bank going to do, Josh? And I think that's what the market is really looking for, at least in the back half of this year.
Do you think, Jason, we see with the big, beautiful bill, would you expect to see pushback at some point from the bond market? There was a lot of hot talk, and for good reasons, debts, deficits, although I'm looking at a 10-year here at 4.25, Jason.
Yeah, and you saw a big backup today from, partly because of the big, beautiful bill, but I also think part of the economic data that came out this morning with JOLTS job data. Ultimately, jobs are looking good. The consumer is looking pretty good. And it all depends on what Jay Powell wants to do. You've got expectations across the board of maybe 3 rate cuts, maybe no rate cuts. And I think there's an argument for something right in between. My personal belief is the Fed should really be focused on at least 1 rate cut to give us some wiggle room. But ultimately, the big, beautiful bill can be very supportive of further economic growth. I think the trend in AI is here to stay. And you're also seeing a broadening out of the rally, right? Over 70% of companies now are trading above their 50-day moving average. And that's something that we traditionally haven't seen over the last 18 months. So for me and my perspective, that's something to be really optimistic about, over the course of the next 12 to 18 months in the market.
You mentioned earnings there, Jason. Q2 earnings season is on deck. Your expectations, Jason, is that going to be a positive catalyst for the market?
I think so. I mean, especially with jobs in the consumer right now and with some more fiscal spending, it should be pretty healthy for earnings expectations. What I'm really looking at too is where are there the pockets of opportunity? Clearly, we've seen a very pronounced growth in a small set of names, traditionally the big tech names. But as I mentioned, you're seeing a broadening out of that rally. And it's not just within the United States. Look at the rally that you've seen overseas. And I think there's a lot of tailwinds when you're looking at Europe. But whether you're looking at the United States or Europe, whether you're looking at earnings or what the Fed's going to do, there's going to be volatility, Josh. And that's what investors need to be prepared for over the course of the next 6 months. And we saw that in Q1 and Q2, obviously with April and Q2. I think the trend is going to be up, but the path on that upward trend is going to be really volatile. Investors need to look for ways to be able to play defense within their portfolios and protect the portfolios while being able to take advantage of potentially some buying opportunities we're going to see over the course of the next 6 months.
And Lou, I want to get you in here as well. Just about that Q2 earnings season, Jason, broadly speaking, expecting good positive things. Is that what you're looking for?
Yeah, I'm looking for that. We're talking about the unmagnificent 493 actually reporting much stronger growth than they have traditionally. Mag 7 still the big driver. But I'm like Jason, I think you need to be opportunistic. This is not a time where you can index per se and just buy the big indexes, even though they're hitting all-time highs. You got to look for pockets of opportunity. Energy is the most underweighted and undervalued sector in the S&P 500 right now, trading at about 15 times earnings. That's interesting to me. I also think you got to think of second derivative plays in AI. If you look at the Q1 GDP report for the US, it was terrible, right? Down a 0.5 percentage point, but there was a full percentage point of growth coming from AI. That's a growth factor that I don't think many people have calculated yet in the back half of the year. So not just names like NVIDIA, find those solution providers. It's not just the chips, it's the platforms that deliver the AI services that could be more interesting in a market like this.
Jason, when you mentioned opportunities overseas, I'm just curious, places like Europe, what interests you about that? Is it purely a valuation call? Is it the stimulus they're providing?
It's a little bit of everything. To your point, Josh, if you look at European stocks, they trade at about a 35% discount to US stocks. So historically, that's quite wide. But if you zoom out on the macro issues, because ultimately trading at a discount to US stocks mean nothing when it comes to investing. It's really about what are the macro tailwinds behind it. You've got central banks lowering rates. You've got healthy corporate balance sheets. And obviously, you're seeing a tremendous amount of fiscal spending. You're seeing defense spending compared to spending that happened during World War II and ultimately World War I, and that's not going to stop. And so with all of those different tailwinds, plus a weakening dollar. So even for American investors with a weakening dollar, it may be advantageous to go and look overseas. I'm just saying ultimately do that with some downside protection in it, because we saw a prolific rally in Q2 in European stocks. We all know that, but I still think it's early within that game. Back to Lou's point, ultimately, though, there's pockets of opportunity here, and I think that investors should also be looking at small caps. Small caps are trading at a tremendous discount against large caps, and I think there's some pockets of growth and opportunity in the small cap space.
Jason, great to have you. Great to have you on the show. Thank you, sir.
Yeah, thanks, Josh.
We are just getting started here on Market Domination. Coming right up, Fed Chair Powell confirms that the Fed would have cut by now were it not for tariffs. More on that on the other side. And at 3:30, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stick around. Much more Market Domination. That's still to come. Federal Reserve Chair Jerome Powell, speaking in Portugal on Tuesday, told a gathering held by the European Central Bank that the U.S. Central Bank may have changed their plans for the fight against inflation, if not for the president's trade deals. Yahoo Finance's Jennifer Schonberger has more.
Hey there, Josh. Fed Chair Jay Powell didn't take a rate cut off the table for the Fed's next policy meeting later this month. And as you said that if it weren't for tariffs, the Fed would already be cutting rates. Listen.
And on the data, and we are going meeting by meeting. I mentioned, how I'm thinking about that, but I wouldn't take any meeting off the table or put it directly on the table. It's going to depend on how the data evolve.
Powell noted that a, quote, solid majority of the Fed's interest rate setting committee thinks it will be appropriate to begin lowering interest rates at some point later this year, explicitly saying in the remaining 4 interest rate setting meetings, which would include the next meeting in July. When asked if the Fed would begin already cutting rates had it not been for tariffs, Powell had this to say.
I think that's right. In effect, we went on hold when we saw the size of the tariffs and essentially all inflation forecasts for the United States went up materially as a consequence of the tariffs.
Powell reiterated that the Fed has not seen much of an impact yet from tariffs on inflation, noting that the central bank expects to see, quote, some higher readings on inflation, but that officials are prepared to learn and that inflation could be higher, lower, later, or sooner than expected. Powell has roughly 10 months left in his term as chair. And when asked what keeps him awake at night, he says he wants to turn over an economy to a successor that is in good shape. Asked whether he would remain on as a Fed governor after his term ends as Fed chair next May, Powell said, I don't have an answer for you today. Josh?
Thank you, Jen. All right, let's take a closer look at the Fed ahead of next week's Fed decision. Joining me now is Carrie Freestone, economist at RBC Capital Markets. Carrie, good to see you as always.
Thanks for having me.
So let's start there, what Jen was just talking about. So Jay Powell says, listen, we could have been cutting if not for those Trump tariffs. What do you make of that when you heard that?
I mean, I completely agree in the sense that we don't know right now what the impact of tariffs on inflation is going to be just yet. And something that stood out to me that Powell reiterated in Sintra was the fact that it's going to take a few months for that to show up. So if anything, it's derailed the Fed's progress towards moving towards more neutral territory sooner rather than later. And we think they're still going to have to remain data dependent. Either way, the trade backdrop is going to put upward pressure on inflation, and we have to see what's going to happen there before they can go ahead with their cuts.
Do you think, Carrie, that investors might be looking through Powell at this point? What I mean is that his tenure's coming to an end next spring, and Trump is no fan of Powell. He's going to, I think, nominate someone who may be closely aligned with his views, his perspectives. Do you think investors may be looking already post-Powell?
That's a great question. And I mean, what I'm thinking about right now is the inflationary forces at play. And I think either way, if history is any precedent, we think that the labor side of the mandate is probably going to bear more weight than the inflation side of the mandate. Having said that, we know there are significant inflationary headwinds at this point in time. So our expectation is actually we think that the Fed will be in a place to cut rates in the fall, but we don't think they're going to have sufficient evidence that that's a permissible move by the time the July meeting comes around. Because if you think about it, we haven't seen the impact of tariffs fully show up. We're waiting to see that play out. On the labor market front, we have seen some weakness in the services sector, and that's something I'm interested in seeing in this Thursday's NFP print. So our expectation is that we think there will be 106,000 jobs added to the U.S. economy in June, a little bit weaker than May's 139,000 print, but we're starting to see some evidence of an erosion in the services sector outside of healthcare, and we saw that with the GDP revisions last week. Services sector consumption was up only 0.6% on a quarter-over-quarter annualized basis. That's the weakest that we've seen since the pandemic. And while one quarter doesn't make a trend, I'm curious after the PCE prints last week to see how that plays out in the labor market data this week, because we saw a pullback in retail last month. We could start to see that again. Transportation and warehousing has been hit by tariffs. And so, it's really looking like the labor market has lost momentum, or at least it's slowed down from where it was last year.
So cooling, not crashing.
Exactly.
On tariff inflation, it's so interesting to me, Carrie, because we're waiting for tariff inflation. And Jay Powell, when we last, he says he's waiting for it, and he's very interested to see how it actually susses out, who pays for it. Is it Carrie and Josh, or is it a producer or a seller? What are the chances, as an economist, that the tariff inflation boogeyman actually never shows up?
I think the chances are pretty low. I mean, it's very unrealistic that the producers are going to be able to fully absorb these costs. And they've indicated themselves that they don't have sufficient profit margins to fully absorb these costs. And so we think that they are going to start to be passed off to consumers. Now, last month's inflation data, we didn't really see any signs of this just yet, though I will mention that motor vehicle parts and equipment did tick higher. Again, 1 month doesn't make a trend, so we're gonna have to see how that plays out. But definitely we do expect it to start showing up, but it takes a few months, right? Because we saw a build in inventories, so those products are going to shelves. People aren't paying those higher prices just yet. But we do expect likely by the end of the summer, we'll have an idea of what that's going to look like.
So the Carrie Freestone call for Fed cuts this year, how many, Carrie, and when do you expect they start?
So we expect 3 cuts this year and 3 likely next year. So we have cuts starting in the fall right now. But again, that does depend on how the inflation picture prevails.
So Lou, Carrie says 3 cuts this year. Does that align with Lou Bassanet's call?
Yeah, I'm not the economist, but I have been an outspoken not cut yet. But I'm with you. July's too soon. I think what's interesting is we're waiting for Godot in the tariff inflation numbers, right? Like, we haven't seen it yet. Does it show up? Powell's getting this indefinite hold. He's playing diplomatic. So I think, for me, everyone's acting as if we're on this perfectly balanced seesaw. If we put 25 basis points over here, it's going to tip one way. It's really not that precise. So I think it's more to your point. When do they start? When does the data justify the cut starting? I could see 1 to 2 by the end of this year, barring some change in the data. But I definitely think we're not going to where the president wants, to ZERP, like he mentioned yesterday and heading into here. But I think everyone's focused on when's the trajectory starting to go down again.
Carrie, finally, I'd be remiss if I didn't ask you about the big, beautiful bill. Senate passes it, goes to the House, of course. Elon Musk not happy about it, one bit, right? He's on X, and he is bringing up concerns, Carrie, that a lot of folks do, including some members of the House, worries about the fiscal challenges, debts and deficits. I'm just curious, as an economist, how do you see that bill?
So when I'm thinking about the bill, I mean, we have the TCJ extension. That's already been baked into our forecast. So at this point, that's not necessarily going to boost consumption. It's just a continuation of the status quo. What's interesting to me is, we have these Medicaid cuts, and we also have an increase in the SALT cap deductions. And so what that means is we're in a situation where we're transferring purchasing power away from lower income consumers towards higher income consumers. And it is those higher income consumers that typically drive the hard data. One thing I want to keep in mind, though, is the fact that higher income consumers do have a higher propensity to save. So just because they have that extra money in their pocket doesn't mean they're spending it. And it's interesting because right now we've seen, again, some weakness in the services sector, specifically in transportation services, accommodation, and food services. That's where wealthier folks spend their money. So I'm worried that this group may be stuck in uncertainty paralysis and maybe a bit spooked in ramping up their savings. So I don't know whether, this bill, once it's passed, is actually going to move the needle when it comes to consumption, or if everybody's just worried about, this uncertainty that we're facing.
So maybe they're worried, Carrie, but I wonder, when you look at the market and the run we've had and you're back at records, the wealth effect for those folks too. How does that variable factor in?
Absolutely. I mean, that really is kind of the driving force behind why we've seen a deviation in the soft data and the hard data. The sentiment data has eroded, but to date, there hasn't been a significant erosion in the hard data. Started to see signs, but not a material erosion just yet.
Carrie, always great to see you, especially on set. Thank you.
Again.
Coming up, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stick around, much more market domination still to come. Welcome to Goodbye or Goodbye. Our goal here to help cut through that noise to navigate the best moves for your portfolio. I'm here now with Prairie Executive Vice President of Market Strategy. That would be Lou Bassanese. You're bullish on Symbotic, Lou, so let's start there. This one, by the way, has already had quite the move. I mean, folks love this thing. This was let me get this right, 70% already this year. But Lou, you say, you know what, you stick with it, you buy it. So let's run through the reasons. The first reason, blue chip adoption.
Yeah, look at this. This is an automation, warehouse automation and robotics and AI play. They've got customers including Walmart and Amazon. So you have the best of the best that have huge scale that can give symbiotic scale very quickly too. So I think you want to go with blue chip client list, not some early adopters that are unproven to deploy it.
Second reason you say it's a buy. Let's go through that. Mega backlog, 22 billion.
22 billion is almost equivalent to the company's entire market caps, right? So you have not the potential of growth, you have locked in growth here that they can work through. It's more about conversion than execution. So I love that from the standpoint of we don't have to guess where sales are coming from. We know where they're at. We can predict and model that very, very accurately across the quarters.
And final reason, scaling now with robots.
Yeah, robots are all the rage apparently, right? Everyone loves humanoid robots. I don't know about you. I'm not going to adopt it early. I'd rather look towards industrial robotics and automation. That's what Symbotic allows you to do. It's scaling now. It's happening. It's about a $30 billion market that exists today, growing to 60 plus billion. We know it's happening. It's real. It's not on the come like a lot of this humanoid robot talk.
All right, so you convinced me, Lou. I'm ready to commit capital. Before I do, though, walk me through the downside risks I need to think about.
Yeah.
Would you say heavy customer concentration?
Sometimes your strength can be your biggest weakness, right? So you have Walmart that accounts for the majority of this backlog. They're going to roll it out through all their distribution centers. Each one costs about $365 million. So if you start adding that up across 45, if Walmart changes its plans or slows the pace, that's going to slow the pace of growth for Symbotic. So you're wed to Walmart's plans here. That could work against you.
All right, so buy Symbotic.
Yes.
So let's move to one you would avoid. Now this one, Tesla, this should get some response on X.
Yeah.
Let's run through the reasons you say you would avoid Elon Musk company. The first reason, I think we can all, political headline risk, certainly something we're all talking about today.
He can't avoid it. He can't help himself, right? And just go start another company. Get out of politics, right? You're doing a lot more for humanity there. I think you're going to see the share price react to his latest tweet and President Trump's response on Truth Social. So I don't like to have that mixed in with my investment money.
Second reason you say it's avoid demand destruction.
Yeah, you're seeing it, right? We're going to get delivery numbers tomorrow. The numbers coming out of Tesla have not been great, even though you've seen other Chinese EV makers doing well. You're seeing a slowdown in Europe as well. I think that first mover advantage is wearing off. They've gotten a premium market valuation for being a first mover that you're going to see keep winnowing and shrinking.
Third and final reason you say Tesla is one to avoid questionable growth prospects.
Listen, if you look at patent filings for humanoid robots, Tesla is not at the top of the list. They only have about 16 patent families. There's a couple other private companies that have hundreds of patents. I don't think Tesla's going to be a huge player in humanoid robots. They're going to make all the headlines for it, but I think that's what everyone's banking on is self-driving cars and these Optimus humanoid robots. I just don't see it. I don't want to invest on what's on the come tomorrow. I want to invest on what's happening today.
Now, before you avoid it, though, what would be the upside risk you should think about?
Man, I don't want to say he's the best salesman in the world, but he is the great vision caster. He's got a loyal following of shareholders. If he can paint a picture of how Tesla grows into its valuation and keeps growing, I think you're going to see that. The shares will rally once everyone knows his focus and attention is on the company and not President Trump.
It's always an entry point because when you talk about this company, Lou, and I'm hard pressed actually, at least right now, to think of another company where there's a parallel like this. Musk is Tesla, Tesla is Musk.
It's like Steve Jobs and Apple, right?
1,000%. And people, there's some strong group of investors, and they go there because they believe in Musk and his vision, and that yes, the future it's robo-taxi and robots, and he's going to win. And that group of people will literally look through those delivery numbers.
Yeah, it's cultish to me, but I get it. It's faithfulness to them. So I'd rather just not. There's other opportunities out there. I don't want to engage in that.
Fair enough. All right. So buy Symbotic. Avoid Tesla, according to Lou. Thank you all for watching. Goodbye or goodbye. More market domination that's coming right up on the other side. Goldman Sachs initiating coverage on Omada Health with a buy rating. For more, we're bringing in Yahoo Finance's senior health reporter, Angelika Anj.
That's right, Josh. We've got some bullish activity from these analysts already on Omada, and this is the first time we're hearing from these firms on ratings for Omada Health after it went public earlier in June. The stock is down about 20% since then, and it hasn't really seen much activity, but we just want to focus on what those ratings are for now. The price target from Goldman Sachs, like you said, $29, and then from JP Morgan, $19. And they are rating it overweight. We've also got numbers from Barclays and Morgan Stanley all started rating the company and covering the company today. So it's going to be interesting to see what they think the prospects are. You can see the range of 3-year growth estimates as well in the low 20s, low to mid 20s. We also know that the stock is expected to kind of boom over time. Really what analysts are looking at is the long-term growth prospect of this company. They're expecting it to be profitable, which it currently is not, by late 2026 or early 2027. And this is the telehealth company that is focused on GLP-1s, not because they sell it, but because they help patients who are on that journey. But behind the scenes, they also cover a lot of other chronic diseases. And that is where these analysts are looking for that long-term profitability and the potential to capture a very large market. The chronic disease market, if you don't already know, is about 50% of the population, and healthcare spend for that is really outsized, with about 85% coverage of healthcare coming from those patients, according to the National Institutes of Health. So this is a really robust potential area. Add on that GLP-1, and that's sort of where the public market was really waiting for this company to come out, and has a lot of hope pinned on it for right now. I did also get a chance to speak to the CEO, Sean Duffy, back when they went public, to ask whether or not they thought they missed that digital health window, or if this is the time, with all the eyes on it and all the pressure on it, to go public. And here's what he had to say about that.
In the pandemic era, we had just expanded to new care areas. And I had sensed that these benefits leaders would really prefer working with one partner across multiple care areas, but we had just started that. And when you're becoming a public company, you want to make sure to have the proof points out there. So we'll hang out, we'll stay private, there's no rush. In retrospect, it was a great decision, that worked out. And then per your comments, I mean, the GLP moment hit. It almost feels like the entire Omada journey leading up to today left us in a place to be able to serve our members on these meds.
As you can see, talking about all those members on the meds coming into the newer markets for chronic disease, pretty close to now, considering their almost 10-year history. So that seems to be the focus right now, an area that has been largely untapped and not been able to bring down really the healthcare spend for many, many years, despite several different attempts. They do have a partnership with CVS that is also lending to the excitement and the bullishness from these firms. So we'll have to see. And I'll be bringing that to you as soon as we find out how they do come the first earnings and onwards.
All right. Thank you, Anj. Appreciate it. Well, the holiday weekend quickly approaching, which means consumers are heading to the snack aisle. But for investors, questions emerging about how to navigate the space with shifting consumer habits, inflation pressures, and regulatory noise. We're navigating how to play the snack sector with the Yahoo Finance playbook. And joining us now is Peter Galbo, food and beverage analyst at BofA Securities. Peter, it is great to see you. So let's talk about this snack sector, Peter. It's a sector people know, they love those names. Broadly, Peter, let's start there. I'm just curious, how constructive or cautious do you feel about that sector, Peter?
Yeah, hey, Josh, good to be speaking with you again. Look, I think we've been a bit more cautious on the snack sector. We've certainly seen that it had been a category grower, particularly within food, for a number of years. And really what we've seen over the past, call it 12 months at this point, has been a slowdown in consumption. Now, there's a big question about whether that's structural or cyclical. We tend to take the cyclical bend on that front, and a lot of that has to do with the pricing these snack companies have taken over the past 4 years.
I'm curious, Peter, we were just talking in the previous segment to our colleague Anjali about the GLP-1s, those medicines. I remember, Peter, when they first hit, there were a lot of questions about ramifications, ripple effects of those medicines, and it was always brought up like, wow, what is that going to mean for the snack sector? Spinning forward now, Peter, we have a bit more data, of course. How are you thinking about that?
Yeah, Josh, it's hard to dispel it completely. We think, again, it's probably more of a cyclical element tied to pricing. And really what we're seeing is that kind of the lower price point brands and even higher price point brands are what are moving. So again, it tends to be more of a price issue, I think, relative to GLP-1, at least on the salty snack side. I think where you're probably seeing a bit more pressure is in sweet snacks, and you see that through the results of kind of some of the sweet snack-based companies. But again, on the salty side, when we're talking about chips, pretzels, that sort of thing, I think it's probably less involved.
And I want to bring Lou in here as well, because I know, Lou, you think about the GLP-1s, the medicines quite a bit. Your thoughts, do they dovetail with Peter's in terms of, you kind of think through the ramifications on the snack sector?
Yeah, I think through the ramifications. Some of your comments, Peter, make me think, like, there's always sector rotation strategies, but within the snack sector, is there companies that are adapting to GLP-1s? Is it really a marketing issue for them? How do, like, Nestle rolls out a Vital Pursuit frozen food line that attracts GLP-1 friendly consumers. Is that really an opportunity? And if so, are there certain names that are doing that better in your universe?
Yeah, I think what we've seen, and it's a great question, it has really been growth in kind of the better for you snacking elements of the portfolio, right? You had Hershey looking to acquire Lesser Evil, kind of a better for you popcorn brand. We've seen the explosive growth at Utz, in particular on their Boulder Canyon brand, which is simple ingredients, 3 ingredients made with avocado oil. So again, has a bit more of a better for you health element to it. And you're seeing pretty tremendous growth out of those specific brands and categories, which is where I think the puck is going.
Another theme, Peter, I want you to take on RFK Jr., now, of course, running HHS. I would imagine, Peter, you're getting some questions from clients about that. What kind of effect he's having on the sector? What are you telling them?
So when we think about Maha and the impact that maybe it's having, we think at this point it's probably more what's being ingrained in the consumer psyche. And so, Josh, as I go back to the point about kind of price and where consumers are hitting the intersection of what we like to think of as price and health and wellness, it's, look, if I'm going to pay $5 or $6 for a bag of chips, I might think twice about the ingredients that are on the back of the packaging before I put that in the shopping cart. Now, that doesn't preclude people from going for some of those better for you snacks that I talked about. But what we're really seeing, I think, is consumers getting more discerning around the ingredient label.
You mentioned a couple of names I want to get your take on here. You mentioned Utz. I just want to dig into that one a little bit, because that is a great potato chip. No one disagrees about that, Peter. But that stock, my friend, is down about 15% this year. What is the issue there, Peter? What's concerning investors?
Yeah, I mean, it's a stock we continue to like. We have a buy rating on Utz, and again, we love it for the angle of better for you snacking, but also good. Again, Utz offers a lot of products kind of at a lower price point maybe than some of the competitors, and something above private label. So it sits kind of in a sweet spot if you're going to take a barbell approach to snacking. I think broader concerns over the category for sure have weighed on the stock and the multiple. But again, if you look at the underlying data, Utz is outperforming the category by several hundred basis points.
One more name, Peter, before we go. I want your take on Mondelez. Now that stock, that actually is up about 15% this year. Looks like the street broadly bullish on this one. Most think it's a buy here. What do you see ahead?
Couple of things there, Josh, that I would point to. One, I think that people don't maybe realize is Mondelez is actually a more European-centric company than it is U.S.-based. And so what we've seen actually in the first half in developed markets around the world is that Europe has actually outperformed the U.S. Mondelez is a large chocolate player in Europe. We've seen really good demand continue for chocolate in Europe, despite the price increases in cocoa. And so I think that's what's been driving a lot of the stock. The second is just, as you've seen, cocoa prices have really come down materially, and even more so today since the start of the year. And so again, as kind of Mondelez climbs the wall of worry on input cost pressure, I think that's where you're seeing the outperformance.
Peter, always great to see you, my friend. Thank you for your time and those stock picks.
Thanks very much.
All right, now time for some of today's trending tickers. We're going to watch Nike and AMC. And up first, Argus upgrading Nike stock. They go to a buy on that one. Analysts say that recovery for the company is on its way, with Argus expecting Nike to dominate in the athletic apparel and footwear markets in the long run. Despite the industry's growing competitiveness, Argus believes that Nike will continue to strengthen its position through global brands, innovative products, and rapid growth in emerging markets. So, Lou, Argus does upgrade this to buy. Target, it looks like they go to 85 here, it looks like. Recovery's underway. They talk about how Nike's clearing inventory so their products are up to date. Are you a believer? Like CEO Elliott Hill, you got the celebrity athletes. What more do you want?
I'm not there yet in the short term, because I believe, if I'm not wrong, if I'm not mistaken, it was a couple weeks ago we were talking about supply chain issues, rising costs because of tariffs that weren't yet resolved. But I do think Nike is one of those iconic brands that is going to find its footing again, no pun intended. Just because, I mean, you and I grew up as children of the 90s, right? It was the only brand in athletic wear. They're seeing what consumer tastes are. But for me personally, retail's a tough space to invest in because of changing and finicky demand. So, but I do think Nike has staying power there. They do the right partnerships. We need another Tiger Woods-esque type breakout star to really to carry that banner for that brand.
I was actually a child of the 80s, but I appreciate,
I
appreciate you saying that, Lou.
I was trying to upgrade us both.
It's nice of you. All right, the other ticker here, we're watching AMC Entertainment announcing a new plan to lessen its debt and take on new financing. The restructuring deal introduces roughly $223 million in fresh capital, aimed primarily at refinancing debt scheduled to mature in 26. So this one's interesting, Lou. I'll tell you what stuck out. Stock's down about 30% this year. You know how many buys on the street, Lou? 0. Goose egg. None. 7 holds, 3 sells. That's all you got.
Which is the biggest rarity you're ever going to see on
not
Wall
see
Street.
that
You
often,
don't see
no.
that, right? There's always more buys and maybe a lone contrarian that's out there as a sell. I'm just still scratching my head. How did we not see bankruptcy through COVID, right? Like if it wasn't for the meme stock mania, I just don't know that there's been that big of a rebound in movie ticket sales, right? To justify this. I think this is at best a melting ice cube of a business model, right? I just don't. When's the last time you went to a movie? I took my daughter to Moana 2.
Yeah.
That's the first movie in forever.
People come on here and there's very smart analysts and they tell me people are still going to movies, box office. Okay, maybe it's not back to where it was pre-COVID, but there's been a recovery there. Maybe it should be a smaller industry going forward, which makes sense because it's very hard to get me off my couch.
Yeah.
I got the couch, the dog, the big screen, and I think it's tough.
But my thing is, can you get excited about investing in movie theaters, right? You have 4,000 other choices out there. For me, you don't have a single buy rating, you know.
Not on this one.
No.
Not one. Goose egg.
You could be the first.
Right, thank you, Lou. Well, while we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.